Hello and welcome. Today we're gonna be doing a little recap of what is happening currently in 2026 on financial markets. And I will be also talking about the biggest opportunities we can see right now on the stock market, bond market, and a little bit about crypto market as well. So first thing first, the war in Iran triggered a massive global oil shock. This is very important because through Strait of Hormuz, the part of the water that connects the ocean to the Gulf countries that produce oil is currently closed, and the traffic through the Strait of Hormuz dropped around 95%. So before it was around 100, 150 ships per day that were passing through Strait of Hormuz. Right now it's around 10, so much less. And that is a very big problem because through the Strait of Hormuz, 20% of global oil and gas, so energy commodity supplies, are being shipped. And right now that is completely blocked. Most of this oil is going to China, India, and other Asian countries, and some of it also to Europe. So those are the two countries that are experiencing the biggest drop in oil, and thus the prices of oil and other energy sources will increase. But this is a global trend. If the price of oil grows, of course the real shipment to Europe and Asia will be lower, but the price will go up nearly everywhere. Of course, some countries are more self-reliant, so there won't be such a big problem. Some countries have so little oil that probably there will be deficits. Some people might not be able to even heat their own house or purchase gasoline for their car, other things like that. That's very important because oil is connected to a lot of different industries. So anything that needs to be transported, shipped, etc., or uses energy to being produced will increase in price, and that will lead to inflationary pressures. This time it's a little bit different than in COVID, because in COVID, first there was a decrease in demand, so less spending from people and businesses, and central banks lowered the interest rate and added a lot of money into the markets through fiscal policies. But right now it cannot be done because the current inflationary pressures are due to higher cost because of higher energy, and the demand is stable. So they cannot really use interest rates to fight this crisis. And what we will see is that the economy will slow down and inflation will go up at the same time. This can be a big problem to many different companies, and usually the stock market reacts very negatively, especially right now because the stock market was very optimistic before and prices of many financial instruments went high up. Many of them were overpriced. So right now, if we see this big problem, the stock market is crashing and we are experiencing extreme fear on the stock market, which is very good if we want to be a long-term investors. If we are looking to buy and hold for many years or just a longer period of time, this is a great time to look for bargains and undervalued stocks. And soon we'll focus on some of the companies that I think are interesting and that have very negative investor sentiment. So if the psychology of the investors is bad, they are more prone to making irrational behaviors, and we can take advantage of that and make a lot of money. Right, so let's focus on the next thing, and this will be currencies. So during this video, we'll look at many different things on my computer in the browser, but most importantly, currencies at the beginning, because it involves all of the different classes of investments. So there is a big problem with US dollar because Iran has this strategy that they are going to bomb and attack all of the different Gulf countries, and they will block the Strait of Hormuz because US dollar it relies a lot on petrodollars. So there are just billions and billions of dollars being used in order to pay for oil. And right now, with the Strait of Hormuz closed, that amount drops to nearly zero. So this is very problematic for the US currency because US is heavily in debt. And if the need for US dollar drops, that can increase the chances of US defaulting. So that's why US bonds became a little bit riskier than before, because there is a huge pressure against the US dollars, because the demand for it is lower, because all of the use that US dollar had in trade on energy market is no longer there. So that can impact the bond market. If we look at some of the instruments, like for instance TLT ETF, this is an ETF that tracks US bonds. We can see that on the 5-year chart, let me zoom it in, we can see that currently we are very low. In 2022, the price of that index grew to 150 US dollars. Right now, it's after a 50% decrease all the way to 86. So if somebody tells you, oh, bonds are safe, you cannot lose money on the bonds, it's not correct. You can lose a lot of money on the bond market. In here, you can see that this ETF dropped from 150 US dollars all the way down to 85 dollars right now, around 50%. So it's massive. But of course, there are some government bonds that are more secure, because this ETF holds different bonds, and when the interest rate changes, the price of these bonds changes. So basically, when interest rates go up, the price of your bonds goes down. And right now, with the higher inflation and problems on the job market, all of that will influence the Fed in order to make decisions on the bond rates. But if you listen to Warren Buffett or any other great investor, they always say that predicting interest rates is very, very difficult. So I don't recommend doing that basically ever. Sometimes, I think in my 10-year experience on the stock market, I had one situation where it was kind of obvious what the interest rates are gonna do, and that was during the COVID, when the inflation started to skyrocket. That for sure was a sign that the interest rate couldn't, at that time they were around 0%, so they couldn't stay at that level for sure. Right, so currently the price on the US bond market is very, very low. However, there is this extra risk coming just from the default of US. We can also see what is the probability of the US defaulting based on CDS for US bonds. Okay, and as you can see, the 5-year CDS grew around 20% in the last month. And current value of the CDS means that the probability of default is around 0.5%. So it's not a lot, but still this number grew because of the Iranian war. And this is only what the market thinks, what the CDS is like. CDS is like a type of a security that you buy that protects you against the default of the US. So if you buy CDS and the US defaults, then you get extra money. Okay, and as you can see, it started growing in 2026, and based on the previous indications here on the historical chart, you can see that since 2022, that default probability of US increased significantly, 2 times more than it was previously, and 20% just in last month. But in reality, that problem can be even bigger because US is at its debt limit. There is a debt limit in the constitution, and for US, in order to continue with the war and other things, they have a budget deficit every year, so they need to increase their debt, and the Congress needs to agree together, two different political parties need to agree in order to raise that debt level. And of course, they will usually raise it, but it is enough for one-time event where they don't agree to terms in order to raise that debt ceiling, and that can lead to default on the whole company. Not company, but the whole country. So you can lose a lot of money on the bond market, although that is highly unlikely, but there is a probability of that happening, and for sure it's more than 0.5%. And US market, because of that, has been declining. We can look at the most popular index, which is S&P 500, and we can see that it experienced a drop. However, it is important to see the current valuation compared to things like earnings of those companies to see if the current price is high or low. So if we compare the current PE ratio, so price to earnings ratio for US companies, currently it sits around 30. So historically speaking, if we zoom out, here we can see the chart for nearly last 100 years. You can see that most often that number was below 20, and right now it's 30. So it is high compared to the last 100 years, but if we just zoom into last 20 years, all right, it's still much higher than the average, but not as much as if we compare to the last 100 years. The last 10 years, it is also very high. The only time it was higher was during 2020, when the profits of companies dropped. So it is a good time to look for some opportunities. However, the whole US stock market is still quite expensive. However, what stocks are currently very cheap, in my opinion, is actually the software companies. Oh, sorry, I was muted for a second there. So what happened on the software market is that there is a lot of fear and pessimism connected to software companies, and later the broad market fear and the price drop of the whole ETF, the whole indexes, led to like a double sale on software companies. So first, the company price fell down because of fear connected to AI, and right now the whole market is dropping, so also those companies. And yeah, let's look at some of the individual companies, starting with Adobe. I have access to some really good data from paid websites. I can show it to you. Coifin is one of them. I also have access to Guru Focus, which is a little bit more expensive. Right, let's look at Adobe. And just to show you how cheap this company currently is compared to the past, we can look at this metric, which is a percentile ranking. All of these zeros here mean that this company has never in the last 10 years been cheaper than it is right now. if we go to 20 years, we can see that, okay, in the period of 20 years, there were 10% of times where this company was a little bit cheaper, but as of the last 10 years, it never has been. And there's a lot of fear connected to AI, but the margins of this company are also the best they have been in the last 10 years. And on the higher spectrum, they have been in the last 20 years. So there's a lot of fear, but we don't see any real problems in the financials. If we look at the income statement, so how much the company is making, we can also see growth here. If we look at this chart here, total revenues, we can see that it is stably growing. So there is fear, but no real problems, at least right now, for this company. Okay, next company is Microsoft. So Microsoft is a very important company to look into because it has a competitive advantage, meaning that this company has, in this case, a monopoly on their operating system on Windows. There are many different operating systems, maybe from Linux, etc., but 90% of people use Windows, and this gives them a huge upper hand. Although what I don't like about this company is that they are investing and trying to change their company into being an AI first company. And while I don't have a problem with AI or investing into AI, it becomes a problem for me when everyone is doing that, when everyone is investing into company. And currently every big company in the US is doing that. Meta, Microsoft, Amazon. I think only Apple is not investing a completely crazy amount into AI. And this can be very problematic when people are going into very hot and popular things. I think when internet started to become popular, every company started investing into like internet cable and stuff like this. And in the end, so many companies invested into this hot internet thing that only 5% of the cable got used. So I am a little bit fearful that it will become the same with this company. And usually there is a lot of money to be made in regions where there's a little competition. But if everyone is going into that, come on, there will be huge competition, which can be a problem for this company. However, if we compare the current price to the last 10 years, we can see that price to earnings ratio is the lowest 10%, price to book ratio also lowest 10%, and price to sales lowest 40%. So not as low, but the margins look good. Most of them are above 50%. And growth in this company is around 10%. If you are looking for something that is popular and has been growing steadily for a long time, Microsoft is a good bet. It might be not as profitable as other maybe riskier options. And yeah, it all comes to the future, what they do with that huge transformation into AI that the CEO is talking about. And also this company has a great gross profit margin, 70%. Actually, Adobe has a higher one of around 90%. It's some crazy number, but basically they have no costs. They are a software company, so they can sell the same program many times and have no extra costs, right? This is great. Okay, next company, I think my favorite pick in here is Constellation Software. It's from Canada, and you can also buy it on the German etc. stock exchange, I think. And let's look at the percentile rank to see if it is currently cheap. And as you can see, this company has never been cheaper in the last 10 years. For the 20 years, it looks a little bit different, but remember when those companies were starting, those multiples looked much different because there was a lot of risk. People were unsure if this company can make a good result in the future. But right now, it is very cheap. We can see nearly all zeros here, meaning that this company has never been cheaper in the past. And let's look at the margins. Margins are also at around 40% for the gross margin, and what we want to see is also the growth of the company. Let's look at the income statement. There's a lot of fear. The company price dropped 40%. This has been the biggest drop in price of this company ever, and this company has been on the market for many years, I think like 20 years or even more, and the price never dropped more than 20%, and now 40% drop. This is the, if you ever were thinking about buying this company, it is the best time to do it. And this company has a great management team. The CEO, I think due to health reasons, stepped down. He's still on the board, and right now one of the CSO, the consolidation software, has like 6 divisions, and the boss of the biggest division is now the new CEO of the whole company. So it's not some random guy. This person was with the company for 10-20 years before. So it is a great pick, so there's nothing to really worry about. And of course the market fears that the company will lose its job because of AI, but as we can see, the revenues are growing stably. So at this point, there is no problem coming from any other source. The price dropped because of fear, basically. The fear of something that may happen in the future. So yeah, it's another thing to look at. Constellation Software, I think, is one of the best companies because it is a great value company currently trading at a very low price. So it's a great quality compared with low price. And this is just amazing. This company is like buying smaller companies, basically milking them for money and using that money to buy more and more small software companies. So it has like 1,000 little programs underneath it, so it's like super diversified. There's not a problem like with Microsoft at all. They go into AI and that doesn't work and they are completely screwed. With this company, the huge diversification, there will be nothing like that. And people are scared that AI will take its job, while in reality, it might improve their business because they will be able to buy software companies at a cheaper price and create new companies at a cheaper price, etc. Next company, HPQ. This company produces like laptops, printers, computers, other stuff like this. So if you're interested in that, it's currently also quite a nice valuation. Although this company has a little bit more debt, so it's a little bit riskier. But if we look at the price, we can see that it dropped also around 40-50% from the high of 37. Currently it's at $20. So also a huge drop, but we'll not go into too much details here. That's just a small position in my portfolio. And the quality of company is not as great as Constellation Software, but you can see also technically that it is quite low, a good price to pay if you ever wanted to buy into this business. Another popular business is Nike. Nike has a strong brand, which is like a hidden power of them. We can see that in financial reports, but it's there. However, due to sanctions from President Trump, this company has been not performing so well, as you can see, even though the price dropped significantly. Let's look at the chart here, last 5 years. Oh, this is not the company. I picked some thing from Poland for some reason. Well, I should look at US, of course. Maybe that was some ADR. Alright, so current price is 44 and the high was at 166. So this is a 75% drop, a massive drop. And on the percentile rank, we can also see it's quite low. However, in here we have price to earnings ratio of 30, which is still quite expensive. So this company is not making a lot of money, and currently it has real problems. So you can see the margins dropped to the lowest levels in 10 years. So low price doesn't always mean it's a great opportunity to buy. Sometimes the price drops because there is some real reasons behind it, but I think that the problems with the company are much smaller than the 70% price drop. Next company, this is a smaller company. If you like dividend, this is something for you. I personally don't like dividend because it's double tax. The company pays the tax on the money, then they send it to you on dividend and you pay dividend again, tax on that dividend again. But if you like it, this company is paying 14% in dividends, so it's a great number. It also hasn't been cheaper in the past. It's also a software company, so also there's fear that AI will take the job, and we can see that the earnings and sales compared to the price are very low. Price to earnings ratio of 8, that's very low, but HPQ also has price to earnings ratio of I think 7 right now, which is very low because HPQ is on the US market, and as we can see the average PE ratio there is around 30, while from the Poland average PE ratio is more of like 15. Gross profit is at 70%, although that has been dropping. This company is not growing, they are just making money and sending dividend to the shareholders. Okay, next one I wanted to talk to car companies, Stellantis and Volkswagen. Those are sectors that are heavily competitive. However, currently the price is very low. Let's maybe look at Guru Focus, because what I want to show you is actually the correlation between the price of the company and revenues, etc. Right. Let's look at the valuation. Currently it's at 87 euro. And we can see that the price to revenue, the correlation is minus 80%. Let's go to the next 10 years. So you can see that usually the price was close to the revenue line. Let me zoom in. And right now the price dropped while the revenue is steady. The same can be said to the book value. So you can see the book value is going up. So all of the equipment that the company has is going up while the price is dropping. And here we have earnings per share, although this is not a great metric because if they invest a lot of money, they can have lower earnings, while in reality the company is growing. And here the operating cash flow, so from their core business, the correlation is 73%. So problem with the margins of this company and some real problems. However, if you are looking to invest into this company, I'm not really recommending that to have like a huge position in Volkswagen, because they are experiencing huge competition from China, which are beating them with lower prices. So this is a very competitive region. Also, Stellantis, another company that is very cheap. Current price to book value ratio is of 0.36. If you see the chart here, current price is around $7.5, so it is very low. It is nearly the lowest price this company has been trading for in the last 10 years. The last time it was in 2020 during the COVID drop. So it is currently low, but because of tariffs, this company has a huge drop in profitability. As you can see in the last quarter, it didn't even make any money. So let's look at the valuation. It will be probably it's a possible value trap. Weird. I never saw that before. So you can see that price to revenue, the revenue is a little bit higher, the same to book value. However, the earnings and cash flows, they just dropped massively, even more than the price of this company. So this is another risky one. So the market, there are many opportunities, but of course it's best to see the opportunities that are like anomalies. So the price is dropping, but there are no problems with the businesses. Also from China, we have some of the giants like PDD, JD, and Alibaba. I've been buying recently Pinduoduo. It's a great company. Also, super investor Lilu is buying into that company. He started buying at $105 per share, so it's nearly what we currently can see. And this company is great. Gross profit margin at 60%, but if you look at growth, the growth in the last 5 years, it was 44% of the revenue, 40% for the 44% for the revenue, 42% for the book value. In recent year, it has been lower, but this company is a complete cash machine with the PE ratio of around 10, which is a great low number. And this website also shows that for them in this model, it also shows that it's significantly undervalued. And it's also a very safe company with not a lot of debt. You can see all the current ratio, quick ratio are also great. And I also wanted to talk about Occidental. If you are interested in investing into oil, because oil went up and you want to make money, you can also do it through investing into oil companies. However, this is not a great time because the price of oil companies is heavily correlated to the price of oil, and currently oil is expensive, so those companies are also expensive, and you want to buy when the companies are cheap and undervalued. So if oil is expensive, those companies will also be expensive. Maybe in a few years the oil will be cheap, and then you can buy those companies also cheap. So remember, on the stock market, you cannot be like late to the party. If the price already of oil skyrocketed 100%, you are too late. You needed to make the decision on the first day of war and not right now. Sadly, but that's it. And for the crypto market, let's look at Ether. This is one of the best cryptocurrencies in my opinion. I personally invest in it because it has a huge fundamental value, much more than Bitcoin, and it is also after a massive price decrease right now, dropping 60%. I also invest in a very niche cryptocurrency called AMP, but here we just see a crazy drop in price. As you can see, this crypto is very volatile. From the local maximum, it dropped 90%. I started buying it low around here, and from that level it also dropped 70%, the current price of less than a cent. So a crazy drop. Crypto market is very risky. Right, and summing up, you can see that some companies, like for instance Volkswagen or Stellantis or Nike, they have very cheap price. However, there are also some problems with the company, real problems, while some companies don't indicate any real problems in their financials, but the price is dropping because of fear that something might happen in the future, but this is not certain. We don't know if Adobe will steal a job from, if AI will steal job from Adobe or Microsoft. Those are companies that are investing into AI themselves, so maybe AI will actually help them. We don't know, that this is uncertain, but the market is in panic mode and they are selling the shares. So it's good to take opportunity of undervaluation that can be created because of fear and other irrational behaviors. So for sure, what we can see is a huge undervaluation for software. Adobe, Microsoft, my favorite constellation software. HPQ, also a tiny bit. Also, I looked into Duolingo recently. In there, we can also see a company with huge margins, not a lot of cost, and we can see, last 10 years, boom, percentile rankings around 0, so it has never been cheaper, and margins very high. And let's look at financials real quick. Do we see, because the price dropped 75% from the top, So if the markets are efficient, we should also see a drop in revenues, earnings, and other things like that. So let's look at the income statement. But in here, of course, we see nothing of that. Total revenues only up. Operating income, this expenses, oh, gross profit, boom, only up. So what is happening on the stock market? It of course just isn't efficient. People are fearful and are selling because maybe something happens in the future to the stock, to the company, but we don't know that. So yeah, I personally like to take advantage over the anomalies on the stock market, and over the time it gave me around 40% annual return. So a great number. And yeah, I also recommend you the Warren Buffett, Peter Lynch, and other great investors. I'm basically using their strategy and it is working very well. Okay, I hope that little breakdown of what is happening on the stock market, where are the currently opportunities, where is fear on the market, etc., where is value, will help you into the future to traverse the waters around investing. And yeah, I wish you a great day. Thank you for listening.